What exactly is the purpose of a mortgage escrow account?
An account that's going to accumulate money to pay your taxes, insurance, flood insurance, and your mortgage servicing company is going to manage that account. So they're going to take money from you as part of your monthly payment, put it in that account. They're going to disperse money out of that account as it actually needs to be dispersed. At your closing, the mortgage company is going to determine how much your property taxes are, your home insurance, if there's flood insurance, and they're going to determine the dates that those need to be paid on and how much money needs to be in there on those particular dates. And then they're going to add typically a cushion. Most commonly, it's a 2-month cushion. They're going to do that in order to buffer against any tax increases.
So what exactly are the different items that could be paid from an escrow account?
Most commonly, we see property taxes, hazard insurance, which would be like your homeowner's insurance policy. And if you're in an area that has flood insurance requirements, that'll typically also be paid out of that escrow account.
When would you start setting up the escrow account?
So the escrow account is always going to be set up at closing.
And how much should you start initially put in to it?
The amount you should put in is really variable as far as where you're at with your property taxes, your insurance, how much they are, when they're due. So it'll be lumped in as part of your closing costs. Everybody's going to be different depending on exactly when you're buying the house versus when the property taxes are due. The closing department at your mortgage company, along with your attorney's office or the title company that's facilitating the closing, they're going to determine how much money needs to be collected in order for that to hit those thresholds. So there won't be a shortage. And we'll talk about sometimes there are shortages and it can cause problems, but that's going to be lumped in with your closing costs.
What I find fascinating is that there's some people who put $5,000-$6,000 down on a home and their closing cost is 10. Their closing cost is more than they actually put down as a down payment.
All the time, especially in Connecticut, because like we were talking about, the escrow account is really a matter of how much are your taxes on the property, how much is your insurance on the property, when is that due? So the higher your taxes are, the higher your insurance is, the more money you're going to need for this stuff. And in Connecticut, as you know, a lot of towns and cities, the taxes can be quite high.
That extra cash that they have to have in the bank, where's that money coming from?
It's, like I said, lumped in with the closing costs. So it either needs to be in the bank ready to go or in an account, retirement, or wherever you're getting money, coming from the seller as a concession or as a credit to you towards closing, or from a gift. Those are really the three main options that you have. Like I mentioned the lender credit, but I want to really be clear that the lender credit is not a very commonly used item because you're going to take a higher rate. So you're going to pay a higher interest rate for the entire life of that mortgage, which could be a long time, just to get maybe $500 or $1,000 back at closing. It usually doesn't make sense.
I'm curious, though, are escrow accounts, are they required for all mortgages?
They're not required on all mortgages.
Okay.
So conventional mortgages, if you're putting more than 20% down, escrow accounts are not required. The government loans like FHA loans, VA loans, or USDA loans, those in all cases I've seen require, even if you're putting more than 20% down on an FHA loan, you still need an escrow account. It's required regardless. It's just one of those rules.
There are some towns where the taxes on the house is equal to the same amount as the mortgage is.
Typically, the higher tax areas or the higher tax properties, you're going to have a bigger mortgage. The mortgage principal, mortgage interest, and the private mortgage insurance, or MI, PMI, that's usually going to be the bulk of your monthly payment. The property taxes and the insurance, while they could be high, they're usually going to consist of a smaller portion.
Typically, and averages, what would taxes be in addition to that $1,200 mortgage?
$400 a month on top of that for taxes, so it's $4,800 a year. Then put another $100 to $150 on there for insurance. So that then puts you around $1,700 out the door in that example you gave.
Well, what are some of the negatives then of having an escrow account?
So as property values go up and tax rates go up, the escrow account needs to be flexible in molding to those increases. So if you're paying an $1,800 a month mortgage, but your taxes go up $500 or $1,000 for the year. Well, that mortgage can't be $1,800 anymore, can it? I've probably had a dozen clients contact me because of something called an escrow shortage. Your mortgage servicer gets notified that your taxes have gone up or your insurance has gone up, and they reanalyze your escrow account, but there's not enough money in there for them to make that payment that they need to make. Sometimes it can actually make sense to refinance, pay off that shortage, and then move forward with the new mortgage at a lower rate, lower payment.
You were talking about escrow refunds, or getting escrow money back.
Escrow refunds are awesome. I've talked to clients this week. One of them's getting over $3,000 back. Another's getting over $4,000 back in an escrow refund. And if you're not told by your mortgage advisor about it, you may think, oh, wait, this is a mistake. What's going on? Why do I have this money? But basically what's happening is when that mortgage is paid off, whether it's by refinancing or selling your home, that money that's left over in the escrow account, that's your money.
Sounds like overall you encourage a mortgage escrow account.
I do. I think in most cases it's good. The ones that I've seen where it doesn't make sense, if you're a very high income individual, you're very good at budgeting, you have all your finances in order, maybe you can handle it. Otherwise, get an escrow account.